Saurabh Mukherjee joins us now. He's CEO with institutional equities with Ambit Capital. Saurabh, good morning. Thank you for joining us. Saurabh, it looks like a bottomless pit for Indian markets. First it was bonds, then it was currency, now it is growth. Everything seems to be just coming together.
These are difficult times. I don't think we can deny that. And clearly, the last 6 weeks, both business and investor confidence has taken a turn for the worse. It's not just in India; it is around the world. But that doesn't make the pain any less clear in our country. That being said, we remain positive on India. We are still advising clients to buy India as we've done so over the last year and a half. And my sense is, to some extent, the whole currency issue, particularly the whole CAD and currency issue, is being exaggerated and overblown. And as in the coming months, as some control is found on that issue, I think a degree of confidence will return to markets.
For some more time though, Saurabh, does it seem the dichotomy in the markets wherein select FMCG, pharma, IT hold out and the rest of the market looks beleaguered, is that trend likely to stay?
I think yes and no, in the sense that clearly what's happening is investors who have to stay invested in India, both the domestic funds and to some extent the large foreign investors, the very large FIIs can't just spin in and out of India. They need to stay invested in the market for long periods of time. Those houses are seeking comfort. They're seeking sort of safe havens, and that's where IT and FMCG is coming in. But that being said, once the worst of this concern and tension around the CAD, the currency abates, I think you will see cyclicals, excluding the banking sector, making a comeback. The banking sector, I think, has more fundamental challenges, especially the top private sector banks. I think the challenges there are a different sort altogether. But names such as a Maruti Suzuki, a Bajaj Auto, a Hero MotoCorp, these are high quality cyclical names within industrials. A company such as Cummins, once you get a degree of confidence returning in the economy, the higher quality industrial names will also come back and find some buyers. But at the moment, people are seeking safe havens, and hence you're seeing IT and FMCG hold up, whilst everything else continues to take a hit.
Saurabh, but I want to stay on the rupee topic with you. Last time when rupee had cracked below 61, the government defended the fall in rupee and they linked it with other emerging market currencies, and they called the rupee fall rather speculative in nature. This time around, we have fallen independently of what is happening to other emerging market currencies, and rupee has cracked at a time when the dollar index has come down from 84 to about 81.5. So do you think the current leg of decline in rupee is largely because of local factors?
I think what has happened was when the RBI intervened 3.5 weeks ago, in a way it stemmed the rot temporarily. And as is becoming evident both from the RBI's own words from the monetary policy 2 weeks ago and from sort of general evidence in the market, as is becoming evident that the RBI really can't stop the slide in the rupee, that temporary period of relief with the RBI had bought us, that is somewhat slipping away. What I think will happen now is you'll get a round of intervention from Delhi, and I reckon it'll be fairly meaningful intervention. It's hard to know the specifics of what exactly Delhi will pull out over the next month or so, but my sense is you'll have sort of three broad sets of actions. One is there'll be import compression measures used. So certain sectors, I think imports will either have tariffs imposed on them or quantitative restrictions imposed on them. The WTO does allow, under special circumstances, the WTO does allow countries to impose such restrictions. So I think there's a reasonable chance you will see such import compression tactics come in, especially on luxury consumer goods. I think the second set of tactics will be around getting a quasi-sovereign such as, say, an SBI to borrow abroad, to issue a $10-15 billion bond abroad. And the third set of measures, and perhaps on a standby basis, will be our country speaking to the World Bank, IMF or the ADB, some sort of multilateral agency, to have a standby facility in case in the mid-September Fed policy, Ben Bernanke does decide to announce tapering, the commencement of tapering then. So I think in a way the RBI's piece is broadly done. The focus very much is on Delhi. And I think in the next 30 days or so, you will see fairly tangible moves from Delhi to address the more fundamental CAD situation, which I have to confess, I believe is addressable. It's not as if we are in such a dire state that $260 billion of reserves, however questionable the quality of that might be, with $260 billion of reserves, a country like ours has to go into a downspin. I think the situation is addressable, and I think New Delhi will try to take steps in the next month or so. But what is clear is the RBI can do very little now, and that 3.5 weeks the RBI had tried to stem the damage, but that's broadly turned out to be ineffectual.
So Saurabh, what is it that you're liking right now? Where does one find value, and what does one buy?
So I think the obvious place to look at is export-centric plays. At 61 to the dollar, we've depreciated vis-a-vis the dollar by 40% in the last 6 years. But more importantly, we have depreciated to the renminbi by close to 75% in the last 6 years. And that's giving our exporters a huge boost. Now, clearly to build an export franchise in places like Africa, Middle East, Europe takes time. It takes time to build your brand, distribution, after-sales service and so on. But the good news is several companies in our country have already done that. So company like Bajaj Auto, for instance, is an obvious beneficiary of this sort of currency. Throw in a good monsoon, election year benefits and so on. And Bajaj Auto should be a relatively straightforward play in the months ahead, labour problems at Chakan notwithstanding. Second company to look at, in spite of the weak results, I would say, is Cummins India. The parent has started posting decent results again. Cummins India has got a well-known brand, proven technology, and distribution not just within India but through the parent into the global market. Third area I would say is pharma. Pharma, in a way, after IT, is our biggest net exporting sector, and Dr. Reddy's in that context is the sort of most out-and-out play on the dollar. And the fourth area, obviously, coming on to IT, even more so than the frontline IT stocks, which are obviously beneficiaries of a weak rupee. I think e-clerks in the small cap IT space is probably the most exposed to the favorable dynamics of a cheap currency. Their e-clerks' costs are entirely in rupees, and its earnings are almost entirely in dollars and euros. So that's how I would look to play a mixture of already well accepted exporters such as a Bajaj and a Dr. Reddy's, play an exporter with credentials but a degree of pain in the P&L currently, a Cummins India, and then play a couple of intelligent small cap exporters such as an e-clerks or even an AIA engineering. That's the best way to capitalize on the current situation without exposing yourself overly to balance sheet pain in what is clearly a difficult economic climate.
X has a very big presence in the KPO business, where operating profit margins are certainly higher than the BPO industry. Let's look at Infosys, and today Infosys has reversed, and it has reversed by about 25-30 rupees. Take the clock back on 12th of July when Infosys, they came out with their Q1 numbers. Infosys was languishing at about 25.50. So after the numbers, which is about 3 weeks, it's been a one-way street for Infosys, and it has added about 400 rupees. Saurabh, is it time now to hunker down optimism on Infosys? Yes, Mr. Murthy is back, but on the flip side, the management, along with the Q1 numbers, also indicated that the environment in the near term is challenging. Nothing has changed for Infosys, and markets are just getting excited.
I think, to be fair to the company in question, whilst part of the rally is the Narayan Murthy effect and the return of the great man, so to speak, part of it is also a perception that there was a degree of operational slack in the company, which will now be addressed going forward, and as operationally the company tightens up under the new head, you will see better results coming through. That being said, whilst we are reassessing our view of the quality of management in light of Narayan Murthy's entry, whilst we're reassessing that, we remain sellers of the company, and yes, I would take advantage of the recent rally to take profits in Infosys. Our stance remains to sell on that stock.
Saurabh, what about banks? Are they anywhere close to the bottom, or do you think there's further weakness in store?
I think that the PSU banks, you could make a reasonable argument that names such as a Bob or a PNB, they're close to half times book value. Difficult to see how much further they can be hammered. My bigger concern is the top private sector banks, but I think there are more challenges going forward. Not just on the asset quality issues, But I think the two other areas where we are concerned is liquidity issues. If you look at the top private sector banks, credit deposit ratios are close to all-time highs, and it's not obvious that even if the recovery were to come through, these banks actually have the deposit base to grow into the recovery. Therefore, what they'll have to do is hike deposit rates to pull funding in to finance a recovery that will inevitably crunch the net interest margins. So on the liquidity front, it's not on the deposit generation front, it's not been a pretty story from the banks over the last 2 to 3 years. And then on the regulatory front, there's a whole raft of regulations coming through, which seem to have particularly inimical effects on the top 6 private sector banks. The regulations vis-a-vis third-party wealth management, dynamic provisioning, intra-group exposures. So our view remains on the top private sector banks that these are fundamentally overvalued, significantly overvalued rather, and there are better places to make money in India rather than to park yourselves in these banks.
Saurabh, very quickly, what is the future for companies like JP Associates, GMR, GVK, Lanco, essentially companies which are sitting on a lot of debt and now even they are finding it difficult to service the debt?
I think you clearly need two sets of things to happen. You need some sort of stock market revival where the balance sheets are repaired, and I don't think I wouldn't look at buying these stocks until that balance sheet repair process begins. And the second thing you need is a stable policy environment, probably in the life of the new government next year. You need a stable policy environment where these sorts of companies actually know where they stand, rather than having to bid for projects and then being told the rules have been changed after the bidding has been done. So both on a balance sheet repair front and in a way, let's call it regulatory repair, both of these have to happen for these sorts of stocks to become investable propositions.
Fair point, Saurabh. Good chatting with you. Really appreciate you taking the time out and speaking with us as always.